Thanks, Keith. As Keith said, it's been a very important year for us and a very busy year. And what I'm going to do before Richard takes over and deals with the financials and Chris talks a bit more about the property aspects is just give you an overview of PHP. And as Keith said, what PHP does is a very, very simple business model. We buy medical centres. They used to be called GP surgeries, but they're now much larger animals. The average lot size in our portfolio is just shy of £5 million a go. And we own them on a long-term basis, structured as a real estate investment trust, which is a tax-neutral, tax-transparent structure, and pay out the net revenue after our management costs and interest charges to investors. And I'm pleased to say in the 24 years we've been operating, we've grown our dividend in every single one of the years. Following our agreed merger with MedicX, which completed in March, we have a property portfolio of just shy of 2.5 billion, and our share price has performed very well and is now a total market capitalisation of 1.7 billion. But you can still get a yield of something like 3.9% by investing in our shares. 90% of the total rent roll of PHP comes from either the British or the Irish governments. All major political parties in Ireland and in Britain, importantly, have a strong, unwavering commitment to the health service. And what drives our business is demographics, not politics. So both in Britain and Ireland, we have a growing population. We have an ageing population, and we have a population that has got a larger incidence of chronic disease as we all grow older, and many of us, myself included, being overweight, leading to type 2 diabetes and things like that. This puts a massive strain on the health systems in both countries. And one of the ways of dealing with that economically is to move more of the care out of expensive, inflexible hospitals into new primary care infrastructure. So what we are effectively is healthcare infrastructure. We have a strong capital base. We recently raised £100 million, reducing our leverage after that to 44%, which was the same level as it was before we bid for MedicX. We have begun to deliver substantially on some of the benefits of the MedicX merger, which have included scale. So we're now in the top half of the FTSE 250. Share liquidity has shown great signs of improvement. We've delivered on the 4 million of cost savings that we talked about in the merger document, and those are all in place. And importantly, we've also begun to deliver, as you'll hear later on some of the financing cost savings that will come as bigger companies can borrow at lower rates of finance. And we've done that. It's been a very, very active year for us. And importantly, we are beginning to see nascent signs, the green shoots of recovery in the level of rental growth that we have achieved. And that's very important for driving future dividend growth. I'm not allowed to talk about that right now, but you'll understand pretty simply that if our costs of finance go down and our rental income growth goes up, there will be more available surplus to be distributed. And obviously when we announce our results in February, we'll be saying a bit more about that. I think I've covered off a lot of the points about the merger already. Let me just check which ones I need to draw your attention to. We now have the largest portfolio of primary care. We have one quoted competitor, Assura, but we have a different approach to buying property. First of all, we're in Ireland, which gives us the opportunity of adding more profitable deals. We have a different approach to buying assets. We're much more selective. We want the large hub core medical centres that are redundancy proof, looking to the future, and we don't develop because we consider that to be too risky. Every deal that we buy is earnings accretive, very important for driving that future dividend growth. Richard and Chris will talk a bit more about that later in the presentation. We have a strong track record, which you can see from this slide. I'm very proud of this. I founded the business as a quoted company in 1996. We've had a 4-for-1 share split somewhere along the way, but you'll have had something like an 11% compound annual return as a shareholder during that period, of which currently just under 4% comes in dividend. Given that 90% of the income comes from the British or Irish governments, as we know, there's a massive commitment to the NHS in this country. This is as close as you get to guaranteed income. We have a strong track record of renewing the leases. Primary care is growing in importance, so we're in a fantastic sector. I'm now going to hand over to Richard, who's going to take you through more of the financial side.
One point you did miss there, Harry, was we've now got the lowest EPRA cost ratio in the whole of the UK REIT sector, which is something we're very proud of. Perhaps looking at some of the relative performance of PHP shares since it was founded. So if you'd bought a PHP share back in 1996, it would have cost you 25p. Close of business today, that is shares valued at just under 145p, and you would have received the thick end of 83p in dividends over that period. So that has delivered an internal rate of return of just over 13% for shareholders. And as you can see from this bottom left-hand chart, the returns we've delivered for shareholders have been very consistently double-digit numbers. So you go back to 20 years, 14.5% compound annual growth rate. Last year we've delivered 36%, which really reflects the benefits of the merger with MedicX. We've outperformed Assura over pretty much every timescale you look at, and massively outperformed the EPRA UK REIT index. Looking at the absolute returns over 1, 3 and 5 years, you can see that PHP has outperformed not only the FTSE All Share Index, but also the FTSE All Share REIT Index. So, you know, over 5 years, you've received a return of just under 107%. MSCI UK Monthly Property Index. This is sort of an industry standard index tracking performance of property. Again, pretty much over every time horizon, we have outperformed the sector. As Harry's already mentioned, we're looking to expand, keep delivering this earnings growth, and we raised 100 million of equity in September this year. That was predominantly to finance a very active pipeline we have of 150 million pounds, of which 16 million is in forward-funded developments currently on site, and a further 70 million pounds is in legals, which we hope to announce very shortly. Now, Chris will come on and talk about the portfolio in a minute, but the majority of this pipeline, around 2/3, is in Ireland, where there are very interesting characteristics and much more earnings accretive to PHP. We also have a small amount of money to invest in our existing assets, predominantly to re-gear leases. But again, most of these assets, as Chris will demonstrate, are quite simple buildings, and they don't take a lot of money to look after. In return, you generally get brand new 20, 25-year leases over the whole of that asset. So I'm going to hand you over to Chris now, who will take you through the property portfolio.
Great, thank you, Richard. Hope you can hear me okay. So there's a lot of numbers on this slide, but a couple of key things to point out. So this is just a summary of our property portfolio. In the middle, PHP, as we were prior to the merger earlier this year, in March 2019. And then this is the MedicX fund, which we'd merged with earlier this year. So it really just gives you an idea of the increase in scale. It's another 50% again in terms of the size of the portfolio. So now we have 485 buildings across the country. We have 15 in Ireland, with a total portfolio capital value of our buildings of 2.4 billion, which are valued every 6 months by external valuers. We've got the best part of 6.5 million square feet of medical accommodation in there. A couple quick points I will make is the average size of our building is £5 million. So we have a large number of buildings in the portfolio, but the average size of our building is £5 million. And the reason why I want to make that point is down here, we give a chart of the spread of the capital values of our portfolio, and it's these parts of the sector which we think are at risk. The smaller buildings, which is where you have your traditional old GP's surgery, we think are the parts that are at risk from the changes going forward in terms of the NHS. So we have a very small exposure to them in the portfolio, and a much larger exposure to the larger buildings where more and more things can be done in the primary care setting. The portfolio has an average lease length, so the revenues to the company have an average contract length of 13 years, spread over, I'll give you an example of the spread in a minute, but it's an average of 13 years. 99.5% of the portfolio is occupied, and 90% of the revenue to the portfolio is either directly or indirectly backed by the UK or Irish governments. This is where we are. all across the UK, not Northern Ireland, but in Southern Ireland. But we're across the country. We are where the need is. So we're in London and the South East with a significant representation as well, across the Midlands and the north of England. And you can see here where we're not let to GPs or for a pharmacy use. Where we're not let to GPs, it is a pharmacy use. So pharmacies in a medical centre should be a pretty robust business. I'm going to flick through a couple of these because I'm conscious of the time. As I mentioned, we have 13 years average contract length, average lease length, where the rents are set, but during that period of time we are able to increase the rents as well. So about a third of the portfolio is either has a fixed uplift that's already written into the contract or has an uplift on an annual basis that is linked to inflation, whether that's CPI or RPI, whether that's UK or Irish. And then about 2/3 of the portfolio is we have a rent review process. Every 3 years the rent is reviewed. It is a process with the doctors and the NHS and the district valuer, and that enables us to go through the portfolio and grow that rent as very loosely linked or indirectly linked to building costs and the replacement costs of the building. So as construction costs and as the costs of putting these buildings there increases over time, our rental revenue can track that over time as well. Again, just conscious of time here, so I just wanted to give you an idea of what some of our buildings look like. This perhaps doesn't show up so well on the projector. Is a medical centre in Kew in West London. Actually, that's not the whole medical centre, that is flats above, but this is something that we do quite frequently in London, is we can buy the ground floor of a development. It's a very good place for a medical centre, for the doctors to open a new surgery. This is actually 3 surgeries that have come together out of old dated premises and relocated into this building, and there's a lot of new residential development going on around it. This is an example of one of our typical medical centres in Ireland. This is Bray, to the south of Dublin, an affluent commuter town. Something's gone a little wrong with our formatting there, but it's a large building with multiple uses. So there's GPs, but there is an urgent treatment centre in there. There is X-rays, physios, dentistry. So these are really healthcare hubs for the local community. We don't do development ourselves, I should make that point, but we fund developers. So for us, that is a good way to get access to new buildings without taking development risk. The developers will take the development risk. We buy new buildings. This is a property which we recently bought in Leeds, which was actually a sale and lease back with the doctors who built the building. And this is another property we recently acquired in Dublin. And these are some of the typical buildings in the portfolio. And another way in which we grow the revenue in the portfolio is that as the leases come towards the end of their natural life, we work with the occupiers who are often very keen to stay in these buildings. We refurbish the buildings, invest new money into them, and in return, we will get an increased rental and a new contract with the occupiers, and that continues to be a good long-term asset for the portfolio. So that is a very quick whistle-stop tour of our property portfolio.
Thanks, Chris. Perhaps just going back, one point which I mentioned earlier is that most of our expansion at the moment, around 2/3 of the pipeline, is in Ireland. And there's some very attractive characteristics there. And just to highlight some of these with a simple illustration. So, these are 2 acquisitions, one in the UK, one in Ireland. The average yield on a UK acquisition is around 4.8%. We knock off the external management fee. The cost of finance, we get a drop down to the bottom line of around 2%. This all assumes 100% debt finance. It's just for illustrative purposes, but obviously we do use equity. In Ireland, we've got a much better net yield, 5.6%. Same management fee, but a much cheaper cost of debt because we're financing in euros, where 10-year Euribor swap rates are pretty much 0 at the moment. We get a drop down to the bottom line of 3.7%. So almost double the rate we're getting in the UK. And as Chris has shown in the previous pictures, these are for buildings that are much bigger than the UK and brand new 25-year leases let to the Irish government. Just coming back to the liability side of the balance sheet, obviously we have a rock-solid income stream. We like to apply leverage to that to drive returns for shareholders. We have total debt facilities of around 1.4 billion, of which about 1.1 billion is drawn at the moment. So we have over 300 million pounds of firepower to deliver that pipeline. 93% of our facilities are fixed or completely hedged out, so we have very little risk to future interest rate rises, not that we're expecting any at the moment. The equity raise, which we completed in September, has reduced our leverage from the 48% that we've got up there down to 44% today. And our average cost of debt, now this is the key for us following the merger, that we're on track to deliver some significant cost-saving synergies in our cost of finance. So we've already reduced it from 4% when we merged back in March down to 3.68%. And we're about to deliver some further refinancings before the end of the year, which should hopefully bring that down even lower. And those really reflect the benefits of scale from the merger. The long average maturity, 7.5 years. And one example of what we can actually achieve in the market now. So in September, we raised a 70 million euro denominated private placement loan note, fixed for 12 years, all in at 1.5%. Very attractive debt compared to properties we're buying yielding 5.6%. Looking at the debt maturity profile, as you can see, we don't have any huge maturity in any 1 year. We are working very hard with all these facilities in 2020 to 22 to reduce, to refinance these, but also reduce the margins, and we expect to see margin savings around 25, 35 basis points. So I'm going to hand you back to Harry, who's just going to finish off.
So what PHP is all about for our investors, which includes the management team, my family and I, we've still got just under 1% of the company. So it's a very meaningful investment for me and my family, is dividend growth. There you are, that's our chart. We're very proud of that. Unbroken dividend growth for 23, 24 years. In America, I think they call them dividend aristocrats, and that's what we aim to be. Given the high quality of the income coming from UK government through the National Health Service and the Irish HSE, we think this is a brilliant investment. I've already alluded to the fact that we might expect in the future dividend growth to be somewhat faster than it's been over the last few years because of the reduced interest cost and greater prospects of rental growth, but you'll have to wait and see what we actually come out with when we announce our results in February of next year. So that's our presentation, whistle stop. There's lots and lots of collateral on our website, including videos of some of the buildings, lots of the buildings. Very happy to open the floor to questions. Now, I've got, before you, could you, if you want to ask a question, let us know, and we've got roving mics that will come to you. Any questions?
Hi there. Thank you very much for the presentation. Could you just give us a few words, please, on the role of the district valuer in the UK and the drivers that they respond to?
Sure.
And also the equivalent, if there is an equivalent within the Irish Republic, and how they may differ.
Sure. Thank you for that question. I hope everyone heard it. In Ireland, all of our leases are linked to Irish CPI, which is currently running at 1.92%, and the Irish government sets the initial rent. They're typically 20 euros a foot, is the sort of, 18 to 24 is the bid offer spread, if you like, and we get an extra 5 euros a foot to discharge the maintenance obligations on the building, all index linked. In Britain, the principal driver, the district valuer is an executive agency of that wonderful organisation, Her Majesty's Revenue and Customs, which we all know and love. So they're not sometimes the most generous people in the world. We think that's actually quite a good thing because it avoids anyone criticising us as ripping off the state, because the rents are set in negotiation with us and our advisors by the HMRC through the District Valuer's Office. And I think the principal driver, in my view, over time is index replacement cost. As the price of new buildings goes up, so they accept that the rent will have to keep pace with inflation. It doesn't say that in the rules. It says an open market value. But if you ask any of the operators in the space, they will say that it reflects index replacement cost. And when MedicX was still independent, Assura, would all agree that the trend in rental growth is on the up. Not a tsunami of rental growth, but better than it's been for the last 3 to 4 years, reflecting the fact that rents do have to go up if they want new medical centres built, because the developer has to make some sort of return, and the DV's office accepts that. Right, next question, please.
Can you explain how the management fee works? I see that on one of the slides there was a set percentage.
Yes.
Perhaps you could just talk a bit about how that
Yep,
deduction works.
it's a reducing banded percentage of gross assets, which reflects the fact we've been in operation for 23, 24 years. The current marginal cost is 27.5 basis points, and it goes down gradually to a final stop of 20 basis points. There are separate arrangements for the MedicX portfolio that we acquired, but the total expense ratio is 0.55, which compares quite favourably with other externally managed vehicles. And as Richard said earlier, the bit I forgot at the beginning is that we have the lowest EPRA cost ratio of any quoted property company, and research by Peel Hunt, if you look at that, it has a chart of that, and that is a fact that's been externally verified. So it obviously comes down to reflect the fact that the marginal cost of managing the properties does in fact come down. And to be completely transparent, there is a performance incentive fee as well, which incentivises us to produce a total return of at least 8% each year. Right.
You mentioned your competitor was Assura.
Yeah.
What about the institutions? Because it looks like they're a cup of tea to me.
Well, the lot size at 5 million is too small for many of them. Where we look at much bigger buildings, like the 20 million in Britain, then we do see people bidding. But when they get into the complexities of managing a lease which is tenants internally repairing, which is 40% of our portfolio, where we're responsible for certain aspects of the upkeep of the building, typically the exterior fabric, they get a bit nervous about it. And the Irish leases, the returns are higher, but the risks are higher because, again, we have to manage the building. There are certain soft breaks in there, but in due course, I think the Irish market is seeing more competition. I think that will lead to yield contraction in Ireland, which is very good for our net asset value prospects. What we don't want to talk too much about that, because we think we've got kind of first mover advantage, and we currently have 220 million-ish of euro investment in Ireland, and we aim to grow that to 400 to 500 million over the next 2 years. And for those who want to ask, maybe the obvious next question is, what do you do about the euro exposure? Well, we borrow 100% in euros so that we're not exposed to euros, because at the moment we think our shareholder base thinks exclusively in sterling terms. You tell me when to stop, Keith. Yeah.
In your pharmacy in your pharmacy related revenue, can you split that into independent pharmacies, small chains, and nationals?
Yep. In one of the presentations on our website, you'll find that split. It is dominated by the majors like Lloyd's, Rowlands, and Boots. But where you read about the chemists having problems, it's their high street branches. We don't own any independent high street things like you'd find on a parade of shops. They're all integral to the medical centres. And I'm kind of quite fond of saying this, so I'll say it again because I'll get into trouble for saying it. You'd have to be a complete nutter to run a pharmacy next to a medical centre and not be able to make money, because although the internet is a threat, if you're in pain, got 2 screaming children, or you're like my mum, 90, right? You're going to go into the community pharmacy and come out with your prescription. And those pharmacies are a very important part. And the other way round as well is quite interesting, because the pharmacist, to quote NHS jargon, is now an integral part of the primary care team. And if you can't get an appointment to see the doctor, which regrettably is still the case in many parts of the country, the pharmacist can deal with a minor ailment, like conjunctivitis, a rash, so many things, bad flu, cold, which the doctor can't really do very much about except rest, have some Lemsips and all that sort of jazz. But the pharmacist can do that, and obviously he can prescribe or give you some OTC medicine to deal with it and say if it doesn't clear up, go back and see the doctor. So the doctors like having pharmacists next door because it saves them actually seeing the patients in many instances.
Please join me in thanking Harry and the team.